The AI investment boom is colliding with rising real yields and an energy squeeze, creating a powerful but fragile backdrop across assets. Welcome to vTalkInsight, Allocator's Lens Daily for August 5th, 2026, where we connect what is happening in equities, rates, credit, currencies, and commodities into one coherent portfolio view. Let's start with equities, where the AI capex cycle is driving both opportunity and new vulnerabilities. In equities, the dominant story is a powerful AI-driven earnings surge against a more demanding rates backdrop. The S&P 500 and Dow have pushed to fresh record highs, supported by third-quarter growth tracking above 6% and resilience in U.S. consumption and investment, especially in AI-related sectors. That combination keeps risk appetite strong, but it also deepens the market's dependence on a narrow set of growth engines. Earnings season has underscored how central hyperscalers and large tech platforms have become. Firms such as Microsoft, Amazon, and Meta are showing clear acceleration in revenue and margins from AI workloads, and around 86% of S&P 500 reporters have beaten profit expectations, the best hit rate in years. Valuation for the largest tech names have compressed from about 35 times earnings to the low 20s since 2022, giving room for the recent rebound. Yet these same companies now carry heavier capex and debt loads, making them more sensitive to higher rates and weaker free cash flow. Beneath the index level, leadership is rotating from pure software to the physical infrastructure behind AI. Industrial names like Caterpillar and Generac are reporting record backlogs tied to data center construction and backup power, while cloud and semiconductor providers highlight surging demand for compute. At the same time, guidance-driven pullbacks in names such as AMD and signs that semiconductor growth may have peaked for now show that markets are rewarding tangible, cash-generative AI exposure and penalizing promises without clear returns. Europe is increasingly plugged into this theme. Regional equities are at new highs, with consensus earnings growth near 17% and strong revisions, helped by semiconductors, basic resources, and financials that benefit from both AI demand and rate dynamics. Companies with pricing power, diversified business models, and credible AI linkages are outperforming, while consumer-facing areas like online retail and airlines are struggling under weaker discretionary demand and higher fuel costs. For allocators, the risk side of the ledger is just as important. Household equity allocations are elevated around 71%. Institutional positioning is lighter, and a third of the S&P 500 sits in a handful of megacaps, amplifying concentration risk. Real yields on treasuries are approaching levels that have historically coincided with equity drawdowns, while single stock reactions around earnings are often exceeding implied volatility, signaling a new, more explosive regime. The equity trade-off today is powerful earnings momentum and AI leverage on one side, set against stretched positioning, rising rate sensitivity, and very binary stock-level outcomes on the other. Turning to rates, bond markets are wrestling with unusually strong nominal growth and stubborn inflation. Recent data point to nominal GDP running close to 7.9%, with a GDP deflator above 6%, even as unit labor costs look contained around 2% year-on-year. Policy is described as only mildly restrictive, and officials stress that more progress on underlying inflation is needed before they can be confident of returning to a 2% target. That backdrop has pushed real yields and term premia higher, especially at the long end. Rising break-evens and real yields in treasuries show investors demanding greater compensation for inflation and duration risk, with 10-year real rates edging toward levels that previously coincided with equity volatility. The term premium on the 30-year has climbed from negative territory to around 80 basis points, and investors remain reluctant to extend duration amid concerns that benchmarks could revisit or briefly exceed 5%. There's growing anxiety that the central bank may be losing grip on the far end of the curve. Markets fear that a rapid attempt to align policy rates with a higher true cost of capital could cause significant disruption, even though the baseline still assumes a pause rather than imminent hikes. Higher term premia reflect questions about debt and deficits, heavy issuance to fund AI-era investment and fiscal programs, and uncertainty over how policymakers would respond if inflation fails to improve from here. Energy and geopolitics are reinforcing this higher-for-longer narrative. Disruptions around the Strait of Hormuz, tight oil and gas balances, and structurally higher supply chain costs are contributing to expectations that long-term inflation may settle closer to 3% than 2%. Some forecasters still expect a lower curve by 2027 as growth and the labor market eventually soften. But in the near term, elevated long-end yields are a clear headwind for duration and a potential break on richly valued risk assets. Those same yields feed directly into the cost of credit, which is where we turn next. Credit markets are where attractive income meets the strains of higher rates and AI concentration. High-yield bonds now offer around 7.25 to 7.5% yields with relatively low duration, and many investors see them as compelling relative to longer-dated investment grade. In contrast, investment grade spreads remain tight, duration is longer, and there is heavier exposure to the same AI-related sectors that dominate equity indices, leaving that segment more vulnerable to both rate moves and sector-specific shocks. Early signs of strain are emerging around AI infrastructure financing. Spreads for hyperscalers and high-yield picks and shovels have widened as a wave of new issuance meets more selective demand, and most recent data center bonds are now trading wider than at launch. New deals often price with spreads in the 6.5 to 7.5% range, with weaker structures clearing above 9%, while some projects face mismatch risk between long-dated leases and shorter revenue contracts. Private credit provides an important buffer. Roughly $4.5 trillion of global dry powder supports demand for bespoke financing and refinancing, including a sizable maturity wall around 2028 in leveraged loans and private software deals. Non-accrual rates have ticked up only modestly so far, suggesting dispersion rather than broad distress. But a renewed rate hike would be particularly challenging for floating rate borrowers already coping with higher input costs and shifting business models. For allocators, the credit story is increasingly about structure and sector, not just spread levels. Key markers to watch include realized losses, the share of interest paid in kind rather than cash, and how easily AI-related projects can refinance as debt matures. Higher yields can continue to attract capital as long as rate moves stay orderly, but concentrated exposure to leveraged AI and digital infrastructure means the asset class could transmit, rather than absorb, any disorderly rate shock. Those cross currents also show up in currencies, especially where policy paths diverge. In foreign exchange, the dollar sits between supportive near-term flows and more challenging long-term forces. On one side, strong U.S. equity performance and renewed foreign demand have prompted real money investors to rebuild hedges, which is dollar positive compared with last year. On the other, many asset allocators remain structurally underweight the dollar, and there is a growing narrative that cyclical global growth and gradual de-dollarization could mean a weaker U.S. currency over time. The yen is the clearest pressure point. Despite repeated and unusually coordinated interventions by Japan and the U.S., the currency has drifted weaker toward 158 per dollar as markets question the durability of any bounce without a policy shift from the Bank of Japan. Expectations for a rate hike as soon as September have risen, while a weak 10-year bond auction hints that investors are starting to price that risk in, even as authorities try to cap volatility. Interventions alone are widely seen as insufficient to generate lasting yen strength. Most commentary suggests that only higher Japanese rates or lower global energy prices would change the underlying fundamentals, especially given record short yen and long dollar positioning. That leaves dollar-yen as a sensitive barometer of global rate and energy stress, linking treasury dynamics, Asian policy, and equity flows in a single cross-asset channel. Energy itself is where many of these themes converge. Commodities, and energy in particular, remain a central source of both risk and diversification. Over recent years, broad commodity exposures have delivered solid carry and often matched equity returns while outperforming nominal bonds, largely thanks to rolling supply shocks. Today, those shocks are still very much present, and they feed directly into the inflation, rates, and growth debates that drive other asset classes. Brent crude is trading in the low 80s, but the more important story is structural tightness. The closure of the Strait of Hormuz for an extended period has cut flows, contributing to inventory draws, physical premiums for prompt delivery, and a roughly 0.5% hit to global GDP alongside more than 1 percentage point of extra inflation. Refined products like diesel, jet fuel, and gasoline command record premiums. U.S. refineries are running near full capacity, and strategic reserves are being run down, supporting high refining margins and strong profits for major producers such as Chevron, ExxonMobil, and BP. Europe faces its own set of bottlenecks. Gas storage could enter winter at unusually low levels, raising the risk of sharp price spikes if temperatures or geopolitics surprise. Low water on key rivers like the Rhine and Danube is disrupting coal and fuel transport, and even constraining nuclear power cooling, forcing businesses and households to curb usage and pushing up transport and input costs for energy-intensive industries. Diplomatic efforts, including talks mediated by Oman, aim to reopen safer routes through Hormuz, but expectations are for only a partial and possibly temporary improvement in shipping. Persistent low traffic and a lack of progress in U.S.-Iran negotiations keep a geopolitical risk premium in prices, even though crude has not yet reached some of the more extreme analyst forecasts, suggesting demand adjustments and route diversions via infrastructure, such as Aramco's East-West pipeline. Meanwhile, energy majors like BP are reshaping portfolios toward higher return oil and gas projects, reinforcing the idea that supply growth will remain disciplined. The net effect is an energy complex that points to inflation settling above pre-pandemic norms, closer to 3% than 2%, all else equal. That limits how far bond yields can fall, supports earnings for energy producers and refiners, but squeezes airlines and parts of the consumer complex already under pressure. For diversified portfolios, commodities continue to offer both a hedge against these shocks and a source of carry, while also being a key input into the term premium and growth expectations that drive rates and equity valuations. All of these threads come together in the cross-asset picture. Across assets, the picture is one of strong but narrow growth engines meeting a more demanding cost of capital and persistent energy shocks. Equities are leaning heavily on AI capex and industrial strength, even as higher real yields and concentration risk build beneath the surface. Rates reflect sticky inflation and rebuilding term premia. Credit offers generous income, but must digest heavy AI and data center leverage. Currencies transmit policy divergence most clearly through the yen, and commodities keep the pressure on inflation via tight oil and gas balances. For allocators, the key is to watch how these fault lines evolve, whether earnings can keep outrunning higher discount rates, whether credit absorbs or amplifies any rate shock, how durable dollar support from equity flows proves, and whether energy diplomacy can ease the supply squeeze before winter. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.